Fed is behind the curve. They're between a rock and a hard place, and there's no good solution for them. They have to choose between, deflation and a market crash or inflation. That's when I think we see the metals respond, and I think that's inevitable. It's just a matter of when. I think gold is going to go to $15,000, and I think that's probably around where the Dow bottoms. I think commodities right now are presenting a tremendous opportunity on a ratio basis compared to paper assets. I don't think we're going to see deflation. I think that the chances of that are very low. We could see disinflation, where the rate of inflation slows.
What do you expect gold and silver to do in that environment, given that they've already been lagging? Do you expect them to perform even worse or take off from there?
Yes, great question. So I like to put everything in perspective and talk about time frame. So if you've got that 1 to 5 year time frame, I think all of this is noise. I mean, it's frustrating. It's frustrating for me to see silver's lackluster performance. But you raise a good point. Typically, when there's a stock market crash, the metals go down in unison, and then they typically recover first. I think that's probably likely to happen again if we see further weakness in the stock market. However, like in previous stock market crashes, 2008, 2012, there was kind of a mini crash. The metals were rising in unison with stocks, and then they fell in unison. Well, it's kind of the opposite story right now. The general equities have done nothing but go up, excluding the last 6 weeks, and the metals have gone down. So I think they'll get hit, but probably not as hard as many people think. So that's my short answer to that.
Okay, and then you mentioned 2008, and that's an interesting one, because if we look at stuff like inflation numbers, monetary policy, real interest rates, all these main drivers, as people call them, for precious metals prices, they weren't exactly the same as they are right now, though, right? Nor was the outlook for them the same that it is right now. So how does that tie in?
Well, I think there were the similar macro drivers back in 2008, 2011. And I think they're even more amplified right now. Namely, the debt situation globally, Fed monetary policy, energy returned on energy invested. All of these kind of dynamics have only gotten more bullish for the metals. And, the natural question to ask, and I wrestled with this myself, is why are they lagging so much when inflation, all the things are happening that we've been talking about for a few years now, but the metals aren't responding the way that you would expect? And I think the answer to that is, whenever we get high inflation numbers in 2021, the market responded by thinking, oh, well, the Fed's going to get ahead of it and raise interest rates, and they're going to squash it. So it's like high inflation was bad for the metals. I think that's probably going to start to change. We saw some small encouraging signs that perhaps that psychology is changing when the 7% annual inflation came out a few weeks ago, and the metals actually rose on that news. So that was a different market reaction than you got in 2021. So, but all that to say, once the market psychology changes, where inflation is no longer bad for metals, and we get a general recognition that the Fed is behind the curve, they're between a rock and a hard place, and there's no good solution for them. They have to choose between, deflation and a market crash or inflation. That's when I think we see the metals respond, and I think that's inevitable. It's just a matter of when. Okay,
a matter of when. I like that, but when you mention deflation, there's another thesis about why precious metals have been dropping. And I spoke to Patrick Bad Charts on Twitter. He's a technical, he's mostly a technical trader. And he says that gold and silver are not lagging indicators. They're predicting indicators. Yep. So in my conversation with him, he told me that gold already went up before inflation went up. So gold, preceded the run in inflation. And so natural question would be, well, if gold's been dropping this last year, well, that means that it's predicting deflation. And if it is, what happens to gold and silver? What happens to gold and silver in deflation times?
So a couple answers to that. First of all, I agree with Patrick that the gold market especially is very forward-looking, more so than other markets like general equities. And I think when the Fed even began whispering about taper and tightening monetary policy, I think the gold sniffed that out and reacted in advance. So I think the next reaction for gold, and it will probably lead, gold's going to sniff out a reversal in Fed policy to back towards easing and the ceasing of this tightening talk. So I think the next move in the metals is higher, and I think gold will be the first to recognize that. As far as how the metals respond in deflation, silver has a tougher time in a deflationary environment. Gold actually does well. I mean, you go back to the Great Depression, gold performed very well, and Homestake Mining was one of the best performing stocks of all, and it's a gold miner. So, gold does well in deflation. Silver struggles, but I don't think we're going to see deflation. I think that the chances of that are very low. We could see disinflation, where the rate of inflation slows. But if let's say they get it down to inflation is 2% a year, I don't think that's going to happen. 2 or 3%. Prices are still going up, and that doesn't negate the 7% we saw last year. That's using government, fake numbers.
I'm just trying to think here. If this is all theoretically, but if they get inflation down to 2% and interest rates up to 2.5%, positive real interest rates, that probably mean that a lot of money will be leaving the stock market because, there'll be sharp disinflation, possibly with pockets of deflation causing panic, which could be positive for gold, even though we might have positive real interest rates. Am I making any sense?
Yeah, I mean, that sounds great on paper, but I don't think it's possible for them to get sustained positive real interest rates. I don't think that's possible without collapsing everything. We saw credit contraction like back in 2008. Just if you look at total global credit, it just goes up and up. And in 2008, just this little blip, boop, and it almost took everything down. So to try and normalize things, I think it's impossible at this point. Here's something to think about for specific to the U.S., but let's call it 30 trillion of national debt right now. Every 1% rise in interest rates is 300 billion in interest payments that are due on an annual basis. So if they get interest rates up to just say 5% on 30 trillion, that's $1.5 trillion of interest payments on, roughly 4 trillion of tax receipts. So the math doesn't work. So that's my answer to that.
Okay. But then, so again, staying in the theoretical realm, sure. You've been at this for a while now. So theoretically, if I were to try my luck, skill, whatever you want to call it, to sort of sneaky try and time it, how can I recognize a bottom? What do you think a bottom for precious metals looks like? Is it a technical support? Is it a spot where, the Fed's not rising interest rates anymore because they cannot, but they're maybe going back around again? What am I really looking for here to get the ultimate buying signal for gold and silver, Steve?
Yeah, I think technicals are our best tool. David Brady, he's my friend. He's also a contributor in our weekly report, did a write-up a month or two ago on 8 signals he'd be looking for a bottom. So I'll just borrow from some of his. And he highlighted some of the major lows. And what we saw is weekly RSI below 30 on the weekly chart. We haven't gotten that yet in gold. You can look at sentiment indicators. I mean, sentiment is pretty darn low, but it's like just that gut-wrenching capitulation, a sharp sell-off, that would likely do it. Or technical indicators, we don't have to see a capitulative, just quick sell-off. We could see more of a rounded bottom and you gradually break out above key technical levels. So there's several things you can look for, but I think the charts are our best tool to know when. And having a strategy is better than trying to pick the exact low. And there are multiple viable strategies.
Okay, so this is the second time I'm hearing this tip about zooming out on the RSI, because I love the RSI. A lot of people do, and it possibly works because a lot of people like it. But so what I've noticed is a lot of people would share these daily or even hourly charts, and they'd say, RSI is oversold, but they forget to zoom out, to the weekly. What is the monthly saying? If the monthly is overbought, and then there was just this short, drop, and then it shows you the hourly chart in oversold territory, but the monthly is still, overbought, then it helps you get a better perspective, I guess. That's what, again, I'm hearing this the second time from also a futures trader who does mostly technical analysis, told me about it. But anyways, what about the gold to silver ratio, or I don't know, silver to something else? Maybe just in general, what about ratios? Is there a magical number that says this is the bottom?
No, there's no magic bullet, but those ratios are very powerful, especially if they're used correctly. And especially as the dollar becomes an increasingly less reliable unit of account, it eliminates, the currency, and you're just comparing things relative to, other real assets. But just going back to one other thing you said before too, another sign of a bottom technically would be a positively divergent lower low. So if you see a lower low in price, but the RSI doesn't make a lower low, that's also another potential signal for a bottom. And you would want to look at that in multiple timeframes, monthly, weekly, and daily charts. Intraday charts, that's more for day trading and short-term trading. And then as far as ratios, yeah, I mean, I know the ratios that I'm looking for a peak in the market. But as far as bottoms, we saw that gold silver ratio of 120 or 130 to 1 in March of 2020. That was historic. That's never happened before. So, I mean, anything near 100 to 1 on the gold silver ratio is pretty indicative that we're close to a major bottom. And then, on the reverse, a gold silver ratio of 1 to 1 is very indicative of a top. So ratios are very powerful for sure.
I think this maybe has to do with human nature, possibly. I want to speculate on it because just extremes in life, they never go on forever. Like, if you're having an extremely hard period in your life, you should know this, but this too shall pass, right? Same thing if you're having a great time in your life, this too shall pass. So extremes never really last. And I guess this, markets move because of human nature, and this is seen in the markets. I don't know if do you think I'm right?
Yeah, 100%. And if you believe that things revert to their mean, it's important to know what kind of investor you are. I think most of your listeners are probably contrarian investors. I am for the long term. So using ratios, when you find things that are beaten down, especially hard assets, as long as you're prepared to be wrong for a period of time, it's just waiting. It's a matter of waiting and waiting for that mean reversion. And, I think commodities right now are presenting a tremendous opportunity on a ratio basis compared to paper assets. It's hard to find a time they've been so undervalued. So it's just a matter of me sitting there holding them and waiting for that mean reversion.
Okay. And I'm sorry for sticking to the same topic here, but it's just, as you were speaking, I was thinking of, the human behavior. And it got me instantly thinking about the premiums, and this will make sense in a second, but I constantly hear these stories about how high the premiums were at the bottom last time. The premiums on physical silver were really high at the bottom, but then the premiums on paper silver were really high at the top. And the premiums on physical silver were extremely high last time before silver did an almost 5x. So is that something that you'll be looking for, like higher premiums?
That's not specific data that I track and I have metrics on, but, I listen to a lot of things like you do. So it's an indicator that will be kind of go into my holistic approach, but it's not something I track super closely. But yeah, you're right. I mean, 2008 paper price of silver was like 10, $11, but you couldn't get it for less than 15, 16. Same with March of 2020. We got down to I think the 11s. It might even been in the 10s for a few minutes. But yeah, good luck getting physical for that. And that was those are both obvious examples of indicators where times when premiums were really high and it marked the bottom.
Yeah. So where I got that from, by the way, before anybody confuses me for being smart, is Bob Moriarty, because he teaches me to look at sentiment indicators and the premiums. So both on the physical and on the paper, silver are usually a good indicator, he says. And so, for example, he's told me to look at the premium to NAV on the Sprott physical trust, but also just that's for the paper silver, of course. But when it comes down to the physical, just generally browse through the shop pages of bullion dealers and see what they're selling and what they're not selling. He says to look at the breadth of the offerings. Like if they have 1,000 silver products for sale and really low premiums, there's probably not much demand, which means that the sentiment is really bad, which for contrarians, as you mentioned, might be a buying signal. And then vice versa. If you go to the what am I talking about? The paper silver, so the premium to NAV on the Sprott physical silver trust. If you look at the last time silver hit almost $50, it was trading at almost 30% premium for paper ounces, right? And so he describes that in his books, and also we've talked about that on the channel as well. But that's a telling indicator that the sentiment is really, really high, and it's probably time to start looking to get out. But do you, I know you like the charts, you like maths and stuff like that, but do you look at the sentiment in one way or another?
It's not something I track super closely, like as far as specific tools I have, but Yeah, I mean, I would say 99% of the time, like if your weekly RSI is below 30, monthly RSI below 30, daily, like if it's just oversold technically, you can bet your bottom dollar that sentiment is also, just down in the, so in that sense, I track sentiment, but not in the way that a lot of people do.
What about subscriptions or in your newsletter? I guess those would be telling, because I've been noticing my
Yep.
YouTube ad revenue and my views dropping over the last year as gold and silver have been massively underperforming. So are you noticing something there?
Yeah. We've been fortunate in that, we haven't lost a tremendous amount of members, but yeah, I mean, growth has certainly slowed. And you do see large numbers of cancellations on days when silver is down a lot or the metals are down a lot.
Really?
Yeah. By large, I mean, it's notable. It's something you take notice of. So that's another sentiment indicator. Yeah, I have that same thought sometimes when I log in and look at our subscriber base.
I guess some people are not really cut out to be it. I'm testing myself, so to see if I'll be able to hold the long term and be a contrarian. But in some days it's just not easy. So and as I just mentioned, gold and silver have been underperforming. But the entire commodity index, so I track the GSCI, so it's hard for me to say, but GSCI, that index, the commodity index, has greatly outperformed the S&P, the Dow, and the NASDAQ combined over the last 52 weeks. That's most likely thanks to oil moving this massively, because that index mostly consists of oil. But gold and silver stocks, which I measure by the GDXJ and the SILJ, because they're more volatile, they have basically done the same move. It's almost the same size move for the last 52 weeks, but they did it to the downside instead of to the upside. So what is that telling you? Is this an opportunity, or is it a warning to collect whatever money I have left and move out of juniors?
Yes. You know what? If you don't mind, I'm going to pull up a chart of
please
gold
do.
Gold versus the Dow and silver versus the Dow. It would have been, I would prefer to do it versus the S&P, but I've got the Dow, but it looks very similar. Let me just zoom out here on my chart, and then I'll go ahead and share my screen. All right, so I'm going to show you this in two different time frames. This is zoomed out to all the way to 1980, and you can see here, just one thing I want to point out is that the Dow gold ratio peaked at 1-to-1 in 1980. Dow bottomed at 850, gold peaked at 850. So here we are way down here. And from a technical perspective, we're kind of hugging the right hemisphere, the lower edge of this bullish arc pattern. And you've also got this symmetrical triangle pattern. This is a long-term pattern. It goes back to 1999. And we're bouncing right along support right here. So I think this is a logical place for gold to begin outperforming general equities. And you're right that commodities have begun to outperform stocks in the last 52 weeks. However, that's coming off like a historic low in that ratio. Like if you go back decades, 70, 80 years, you won't find a time when commodities have been so undervalued. So even though they've outperformed in the last 52 weeks, I think we're just in the press, on the cusp of a new trend. So now on this gold Dow ratio, when we zoom in a little bit more, going back to late 2018, you can see a smaller pattern that's formed right here, right above this horizontal support. You've got this trend line support. So last week, gold actually, when stocks were suffering, so actually 2.5 weeks ago now, gold broke out from this pattern, and now we're kind of back testing it. So this is going to be worth monitoring very closely, because if gold can begin to outperform general equities, that's going to catch the interest of generalist investors who only care about performance. They're not worried about currency debasement and all this. They just want performance. And if gold begins to outperform their general equities, that's going to capture their attention. And then when you look at silver versus stocks, we're at a very interesting point right here. Let me zoom out to the longer term. I'm going to use a weekly chart to show this triangle pattern a little bit more clearly. Yeah, this is silver versus general equities, and it looks very similar to gold. And we broke out a few weeks ago broke out in convincing fashion. And now we're just simply back testing that breakout line. So again, it's going to be very, very interesting to see if the metals can begin outperforming general equities and over the intermediate term here.
You just show the chart where we saw that 1-to-1 gold to Dow ratio, just to speculate a little bit. What would a 1-to-1 gold to Dow look like in our time? Like, would the Dow have to drop 90%, or how do you see it happening?
Well, it's fun to speculate on that. Why I like ratios is because it works in deflation, inflation, whatever. If we return that 1-to-1 ratio, whether it's $5,000 or 20, You know, I think based on historic cycles, you know, it may sound sensational with gold down around $1,800, but I think gold is going to go to $15,000. And I think that's probably around where the Dow bottoms. You know, it's a rough estimate, and that's over the next, you know, 3 to 5 years, 6 years even.
But so a 50%. Let me tell you, we were just talking about extremes. That would be an extreme, right? And that's probably a time where I should be looking to get out and probably start going into US value stocks. Is that how you would do it?
100%. Yeah. I'm glad you mentioned that, because I saw you post on Twitter the last few days talking about dividend stocks. And I think that's so smart. I mean, that's my plan too. First of all, I don't plan to hold all of my metals until we hit a Dow gold ratio of 1 to 1, even though I think that's probably where we'll peak. That's part of my long-term exit strategy. So when we start getting down to like a 4 to 1 ratio, 3 to 1, you know, you scale out and gradually scale out and reposition into undervalued general equities. And you know, this is almost treason to say in the gold community, but I look forward to the day where I can just invest in a basket of dividend payers and not worry about it all the time. It's just, I can't bring myself to do it right now because of the valuations and the ratios and everything. But I look forward to that day when I can just buy a basket of dividend payers and not look at this stuff all the time.
I mean, I don't know why it would be treacherous, because that's, I mean, I want to believe that that's why we do it, right? I mean, I'm in this to make money and get my portfolio to a point where I can indeed diversify it across different asset classes, among which dividend stocks. But I'm not doing this to be right or anything, right? I'm not doing this so that I can have a system collapse and then tell everybody on Twitter, "Hi, I told you, now I'm in my basement," or whatever. You know, I'm doing it to make money, and now I'll use whatever helps me get there among the natural resources. And by the way, as I'm mentioning this, I'm reminded that yes, you are the Silver Chartist. It's probably hard to speak against your own book, but I know from following your newsletter that you are seeing some other stuff that might have potential. But besides natural resources, is there something that's pulling your attention, like tech or crypto or anything that you think has a slight chance of outperforming silver in that 1 to 5 year period?
I think what has the most likely chance to outperform silver would be